Good morning. John Cowan, Ultra Realty. It's the start of a new week in the hot month of July, which means another Monday morning real estate message from me. Folks, I'm working with a lot of sellers and buyers, but today I want to talk about the buyers. And I want to talk about what the general questions are that we run into consistently. I have more mature buyers who are downsizing. I've got first time home buyers, and I have in betweens. So let's address, what does it take to qualify for a home mortgage? So buying a home, what do you need to know about financing? So here's where we're going to start. I'm going to give you some bullet points, and then I'm going to try to give you some detail, but please understand this is a very minimal amount of information for a big process. So how do you qualify? You need to understand there's a mid FICO score that is not an average. It is a middle score that is not the same as a retail score that you may get from your bank or Credit Karma or any of those sources. It is a mortgage FICO score. You need to remember that. Also remember that you are entitled to one free credit report from each of the three major credit reporting bureaus per year at no cost. Now, if you want your mortgage FICO score, they'll charge you about $10, okay? But it's worth it so you know what your middle score is. Those agencies are Equifax, Experian, and TransUnion. Here's your goal, bottom line. You want a minimum of 640 for a middle FICO score to qualify for an FHA mortgage. You want, as a goal, 720 to qualify for a conventional. Can you do a mortgage with lower scores? Yes, you can. It can work, and it can work because you're going to be penalized a little bit on the interest rate. It'll be charged a little higher, but with the interest rates being so ridiculously low historically, it's still going to be far better than renting, I can assure you. So that's item number one. Item number two, DTI, debt to income ratio. What does that mean? Here's what it means. You take your combined gross household income and you divide that into the amount of, let me say, long-term debt that you have. Long-term debt would be your mortgage, your new mortgage calculation, student loans that you're actually writing checks and paying, credit card minimum balances, and auto loan. Those are the types of debt that are going to be considered. If you take your debt and you divide into it your gross household income, you're going to come up with your debt to income ratio. The goal is to be in the 40 to 45% range. As an example, if you have $3,000 in debt and you have $7,000 of combined income, that is a DTI of 43%. That's it. That's where you want to be. Income. That's the other big bullet that I want to talk about. So we've got FICO score, we've got debt to income ratio, and we've got income. Income can be salary, normal W-2 salary. Gross amount is counted by the lender. If you're self-employed, you're a 1099 person. They're going to look at your net income. We'll talk about that in a second. If you have commissions and bonuses that you get over and above your salary, for example, those need to show a history of 1 to 2 years of consistency before those can be counted in addition to your salary. So let me go back to a self-employed qualification because I'm self-employed. So one of my clients years ago boasted that he makes six figures, and we were going out looking at properties. And I kept trying to explain to him that we need to know what his tax returns show as his net income. He said, it doesn't matter. I make six figures, that's it. No, it's not it. The mortgage company will take your net figure that you pay taxes on, and for a lot of us, that's dramatically different than the gross amount of our self-employment income. So for example, how much house can you afford? There's several factors, but let me just give you a real simple math equation. About 3.5 to 4 times your income. So if you had income combined of 7,000, about 3.5 to 4%, you're going to be in the 250 to $280,000 price point for a home. So we want to make sure you're not searching houses that are outside of what you're going to be able to qualify for. So how much will my payment be? Okay, if you use a factor of 6.5 times the cost of the home, so if you're looking at a $250,000 home and you multiply that by 6.5, you're going to get in the neighborhood of about $1,600 a month for your total payment. That's principal and interest, insurance for your homeowner's policy, and your taxes. So can that vary? Of course it can. Our tax rates are different in different counties. You may have a higher cost of insurance than someone else has. So all those are factors, but that's a round number. And if you were looking at a $350,000 home, that payment is going to be approximately $2,300 a month all in. That's near the DFW median price point for a home here in our area. So what about down payment? What about first-time home buyer programs? So we've got 0% opportunities with VA and a USDA type of mortgage. Those are mortgages that are sponsored by the federal government, and you can get 0 down payment. Different qualifications for them. VA, if you qualify as a veteran. USDA, to get that loan, that's more of a rural area, so we would need to go outside of the Metroplex. For example, Forney, Heartland going north, Anna, Melissa, Van Alstyne, so Little Elm, parts of Little Elm qualify. So going south, the same thing. We need to get about 15 miles out, and you can qualify for that 0 down loan as well. FHA requires basically a 3.5% down payment. Conventional, you may hear Fannie Mae, Freddie Mac terms. Those are government-sponsored entities that secure those loans. That's a 3% down payment. Can you do a down payment assistance program? Is there such a thing as a first-time home buyer deal? So really we're talking about a first-time home buyer down payment assistance, and that can be 3 to 6% contribution by an outside entity for you to qualify on purchasing a home. A great program. Your interest rate's going to be a little higher. The cost of money isn't free. Okay, so those are the generalities that I wanted to share with you today, and let me give you a few others. Big banks, not necessarily the best option for you to get a mortgage loan. Mortgage lenders, where that's all they do, that's really the preference. Pre-owned homes versus new builder homes. Is there a difference? There is. A lot of the builders have their own mortgage arms, and sometimes we can get more incentives working with their own lending institution. So there's just a lot of different opportunities here to help you qualify. So make sure you've got a realtor representation. That's me. Make sure that you have a good qualified mortgage professional. We then make up the team that you need to make this work for you and your family. I tell my buyers I want them to start the financial process up to 6 months ahead of when they actually want to buy a home and move. Why? Because we always need some tweaking of the credit scores and tax returns. You might want to change some things on a tax return. And landlords, I'm a landlord, so landlords might be flexible with you moving out before the end of your lease. I can talk to you about that. Why would that work? Here's some things not to do. Do not go to credit counseling. Do not allow an outside entity to start making suggestions on what you do before you talk to a mortgage loan professional. They can do damage that will prohibit you from being able to qualify for a home mortgage for quite a period of time. And credit cards, same thing. Do not, on your own, start paying things off and trying to pay off a little medical collection or something of that nature without getting counseling, which is free from the mortgage lender. That's it. Real quick, real simple, some basic bullet points, the things that I counsel all my buyers with before they ever have to get on the telephone and talk to a lender. Call me, John Cowan, 214-697-1146. Thanks, and until next week.